Chapter 4, Managing Income Taxes. So what our goal here is to seek to do tax planning. So we're going to seek any legal way we can to eliminate, reduce, defer income taxes. So it's always always going to be better to pay if you pay them later. That's the idea with regard to your retirement plans. That's why they receive that tax treatment. You'll pay taxes on them when you withdraw that money from your retirement plans. So the key here is reducing taxable income. So taxable income is the income that taxes are levied upon. So not your total income. You'll have a series of deductions that you're able to make before your taxable income is determined. So to achieve financial success with regarding managing income, sign up for tax advantage employee benefits in your workplace, 401k, health insurance, flexible spending accounts, transportation reimbursement accounts, that's not a complete list, but that's probably the biggest. Contribute to your employer-sponsored 401k up to at least to the amount of the employer's matching contribution. Buy a home to reduce income taxes. I mentioned this when I was talking about and doing the lectures for last chapter. This book has not been updated to reflect the changes to the 2018 tax code. There's actually a newer version of this book from 2019, and for some reason it did not make those adjustments. So anyway, I attempt to overcome that through these lectures. But anyway, because of the changes with regard to standard deductions, the vast majority of people don't itemize anymore, which home expenses relating to owning a home, mortgage interest, and points and property taxes they fall under itemized deductions. So for a married couple in 2019, the standard deduction was $24,400. So in order to deduct those expenses, they would have to exceed the $24,400. And there's also a $10,000 limit on state and local taxes as well. So it makes it very, very difficult to clear that threshold on the $24,400. Next, do your own tax return so you can learn how to reduce your income tax liability. It makes you more familiar, makes you aware of what drives your taxes. Maintain good tax records. The IRS, Internal Revenue Service, can, if they choose to audit you, they can go back up to 7 years. And one of the rules that I try to live by is avoiding conflicts with agencies that make up their own rules. The first two that come to mind are the Internal Revenue Service and the Securities and Exchange Commission. Both of them, they make up their own rules. They can, some activity you engage in can be perfectly legal 1 year. However, if they determine it to be questionable, they can come in and after the fact and say that it is not legal. So, okay, first learning objective. We're going to talk about the progressive nature of income taxes and marginal tax rate. So what are taxes? Taxes are compulsory required charges imposed by government on citizens. So and their property. So it's the fees that you pay to live in a certain place. Obviously federal income taxes, but for example, if you live in Bell County, you would be subject to Bell County property taxes, which includes the the county, the city you live in, the school district that you live in. So those would be property taxes, but similar idea. So Internal Revenue Service, or IRS, is the federal agency that oversees the tax system and collects taxes. The set of laws that govern taxes are called the Internal Revenue Code. They were created by Congress. They've been amended many times. Most recently, in 2018, there's actually some language in the stimulus package that could potentially affect your taxes as well. Progressive taxes. As I mentioned, the federal income tax system is progressive by nature. What does that mean? It means that the taxes is a high, that your taxes increase, the rate on your taxes increase as your income increases. So we'll see that in a minute as we go through. Start talking about tax brackets. Regressive tax is one that demands a decreasing portion of your income as your income increases. Probably the best example of that would be the Social Security portion of FICA. If you make over, I believe, $132,500, I believe that's a 2019 number. Any amount over the $132,500 would not be subjected to the 5.65% Social Security tax. So that is definitely a regressive tax. So if you make $500,000, the percentage of your income is going to be much lower than somebody who makes less than $132,500. Anybody who likes $132,500 less is going to be 5.65%. So talk about marginal tax rate in the next lecture.